Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, and special guest, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. What a week, what a show. In studio guest, the audience has spoken. I have listened. I'm bringing in two heavy hitters in their respective domains, Miss Catherine Hunt and Miss Lucy Hunt. Say hello, ladies.
Hello.
What did you guys just finish up doing this afternoon?
We swam. We did some swimming.
Okay, so you did some summer swimming. Did you learn anything while summer swimming that could be applied to investing? Any lessons for the audience that you could share? Anything?
Well, we got some candy, some popsicles, and so we worked on our money. They also had a little craft that you could do. So we worked on spending our money at the cashier.
Okay, now, were some products expensive and some cheap?
Yes, most of them were either $1 or $2.
In this inflationary environment, that's quite a price. Well, that's a great segue for us because three articles, really two articles and two data points, but the first article we're going to look at is Why Stocks Are the Greatest Asset Class by Nick Maggiulli. And it's kind of related to that summer swimming inexpensive popsicle lesson. The next is by Mr. Morgan Housel, one of our favorites. Probably would be a friend of a show if he knew about us. He talks about the slow and steady compounding effect that can happen with true investors. And then we end with some lovely data points about NVIDIA and the S&P 500. But at the top, we are looking at Mr. Nick Maggiulli. Headline, Why Stocks Are the Greatest Asset Class. Now, this is always a bit of a challenge, okay? In the arena of available investments, it has been my experience that the index fund in particular is never marketed or talked about at the water cooler, or I've yet to have this happen. Someone invite me to lunch at a lovely restaurant or take me to a ball game, turn to me quietly and say, "Have you ever heard of an index fund, Mr. Hunt? Could I interest you in this incredible financial product?" And why, sisters, do you think no one has ever taken me to a game or a nice lunch and whispered, "I have a nice product called an index fund for you"? This is a hard question. The sissies have not been prompted for this. What do you think?
Well, do they know you?
This is a great question because there's a safety element here. And you're saying if they did know me, surely they'd be aware that I love the index fund. So in many of these instances, they don't know me like you guys know me. Because you guys know what would happen if you guys took me to a nice lunch at your favorite spot. What's your favorite spot to eat lunch?
Probably Company Cafe. Company Cafe.
Okay, so you take me to Company Cafe, and then you lean across the table and you say, "Dad, I have a really great investment. It's just expensive, and the time horizon's short, and it's really complicated." What do you think I would say to that?
No.
Violates the very core tenets of the sermon I preach every week. So, Mr. Nick Maggiulli, when he says why stocks are the greatest asset class, he talks about how he's always been a fan of stocks. Now, what are stocks? It's always good to go back. Stocks are fractional ownership interest in operating companies. So what's a company? I remember the great story of Mark Zuckerberg when he was first going to Silicon Valley. He didn't know what a company was. No one told him what a company was. His dad was a dentist. He went to Harvard. Not everybody can go to Texas A&M. He didn't know what a company was. So what did the man do? He went out and started what he didn't know what it was. But, well, a company is something that produces a good or a service, ultimately for a profit. So girls trivia, can you name a company, a publicly traded company that maybe your family has ever been to or shops at, or think of a company?
Walmart?
Correct. Walmart. Ticker symbol WMT. Walmart. So Walmart, if you buy Walmart stock, it's a fractional share. Well, did you know there are index funds? And this gentleman talks about the Bogle effect. So check this out. According to Eric Balkunas in The Bogle Effect, retail investors have saved over $1 trillion in total because of Bogle's efforts. Not only did Bogle reduce fees for investors at Vanguard, but he inadvertently brought down fees for the rest of the investment management industry as well. That's called competition. That's called capitalism. So when you invest in common stocks, you're entering an arena that the costs are very low if you know how to work because of this Vanguard effect. They call it the Bogle effect. So by lowering fees, Vanguard, now this is what's incredible. Vanguard has captured an increasing market share, so all the way up to, I think, 28%. But all the while, it's kept the same share of revenue for the industry. So if you could visualize this chart, you can in the show notes. It shows Vanguard's from 1990 to present increasing up, share of industry assets, and an absolute flat line on share of industry revenues, meaning Vanguard is lowering their prices as they get more assets. This is unheard of in the investment management business, at least until Vanguard. And now people do it all the time. So Vanguard, the article says, was able to capture an increasing share of the market without extracting an increasing share of the fees from customers. So the rest of the industry followed suit. So this is why I like stocks too. But I'm going to read this right here. This is, the author says, this is why I believe stocks have an edge over most other asset classes today, because many of the things that were once prevalent with stock investing and are still prevalent among other asset classes today are no longer an issue. When investing in stocks today, you can get the market return without paying a high management fee, a hefty sales load, or other phantom costs. As Jack Bogle once said, investing is what you don't pay for. Sadly, there is still a lot you do pay for investing in private equity, farmland, or any other asset classes. So whenever that complexity cranks up, and that's not to say some of these asset classes can't do very well for you in all these spaces, but all things being equal, girls, would you rather pay a high price or a low price?
A low price. A low price.
And when you're at the pool and you're looking at treats, a high price or a low price?
Low price. Low price.
Here's where things get complicated. This is where the world is not training you well for investing, but hopefully this podcast is. When you go to the pool, girls, and you're thinking about buying treats, and you spend $10 versus $1, which one is going to get you more, the $10 or the $1?
$10. The $10.
Correct. It's simple math. You're going to get 2 popsicles, 3 nachos, whatever. In investing, the inverse is true. The less you pay, the more you get. What? That's so different than every other arena I enter into. Even the automobile. If you buy a car, you'd rather have a more expensive car almost always. But in investing, they charge in a manner of percentage. So the less you pay, the more you get. It's very confusing, and it wages war on our brain. So I like common stocks. I like index funds because you get to go really cheap. And then there's volatility. So stocks as a whole, this article outlines, they can decline by 10% every other year, 30% every 4 to 5 years, and 50% once a generation. That means top to bottom, 50%. That scares a lot of things. That's why it's hard to own. And that's why when people say, oh, that's so easy. No, it ain't. It ain't easy. Staying on a bucking bronco is not easy. Have you ever ridden a bucking bronco?
No.
Have you ever ridden a bucking bronco?
No.
Have you ever tried to chase a pig at a rodeo?
No. No.
I thought you had. Have y'all not chased an animal at a rodeo before?
Actually, yeah.
Actually, yes. That's what I thought. Yes. Out in Fort Worth, yes. Lucy remembers. Got to know. Okay. Was that hard, Lucy, to capture that animal?
Yeah.
Very. Okay, very. So there's a lot of volatility there. You remember. Catherine remembers now. That just shows you guys we're doing things live. That's the authenticity of this show. A lot of shows are curated. They're phony. They're fake. Not this. We're real. We're genuine. So I've just remember, just because an asset class and a manner of investing is not hyped, it's not spoken about in quiet company at nice restaurants or at ball games, doesn't mean it's not awesome. Because index funds are awesome. They're great. Thank you, Lucy. Next up, Mr. Morgan Housel, one of our favorites. I love this quote he starts out with. It says, "Nature is not in a hurry, yet everything is accomplished," said Chinese philosopher Lao Tzu. What do you think that means, girls? Nature is not in a hurry.
Well, nature, it just kind of grows. You know, out in the wild, there's not someone who tends to it or takes care of it. It just kind of grows. So it just has its own speed, its own time.
Amen, oldest sissy. Now, oldest sissy, can you connect that to investing in any way, what you just said?
Well,
It's not easy, because this is where we have to use natural revelation, God's created order, and seek to apply it to the science of investing. So what you said, Catherine, that pricked my ears was, it goes on its own. Is that fair?
yes.
Does it appear hurried or rushed?
No. It goes just its own time.
With the Almighty Index Fund, could we not say the very same thing about the Almighty Index Fund?
We could say that.
We could say that. I think the connection bears repeating. So Mr. Housel is seeking to make that connection in our minds that young Catherine Hunt just made, future middle schooler Catherine Hunt. He says giant sequoias, towering mountains, jaw-dropping features, silently, slow growth, never visible right now, but staggering over long periods of time, quiet compounding. He says this great quote. He says, every few years you hear a story of a country bumpkin with no education and a low-wage job who managed to save and compound tens of millions of dollars. The story is always the same. They just quietly saved and invested for decades. They never bragged, never flaunted, never compared themselves to others, or worried that they trailed their benchmark last quarter. Their financial universe was contained to the walls of their home. And that's true. You will see this occasionally. It'll hit the news. Someone leaves a certain amount of money, and it was never expected. But Mr. Housel, what he is reminding us is that you have to have a certain rubric, a certain framework in order to do this. The reason why this is so rare is because it's difficult. So what he does is he seeks to encourage us with these 4 concrete details. Number 1, an emphasis on internal versus external benchmark. Girls, do you know what that means? Internal versus external? Okay, you're not there yet. You haven't gone to Covenant College yet?
No.
Okay. I understand. So, have you ever taken the ERB test?
Yes.
Your scores came out today.
Oh.
Oh, yeah, I found out. That's an external benchmark. It's a benchmark. You get a score, it shows up. An internal benchmark that no one sees. That's a little harder, isn't it? That might be waking up before everyone else, working out, coming back home. So the social comparison game would be bragging to your friends about your ERB scores or others and thinking that somehow the ERB is this competition, whereas an inward comparison would be, hey, how can I learn? How can I get better? I'm not seeking to prove anything. You understand that distinction between inward and out? Okay, the same thing happens in investing. We either invest because we want people to know we're doing great investing or to simply serve the needs of our family and our wider community. So that's number 1. Number 2, an acceptance of how different people are and a realization that what works for me might not work for you and vice versa. He quotes, this is Housel quoting a gentleman. He said, there's only one success to be able to spend your life in your own way. And a lot of, this is important, a lot of financial mistakes come from trying to copy people who are different from you. So be careful that you're not trying to take the giftedness perhaps God has given to someone and trying to apply it to yourself and therefore replicate their lives. No, focus on the giftedness God's given you and do the best you can with that giftedness. Okay? And then a focus on independence over social dunking. That's a phrase you girls may not be familiar with. Social dunking. You ever heard of that?
No.
It's okay. What's it mean to dunk someone like in a dunk tank? What's a dunk tank?
It's something where you kind of get a ball and you throw it at it, and then somebody's on a little ledge and then it falls off.
How do you think the person on the ledge feels?
Kind of scared. Scared, probably.
Okay. As an adult, I can also feel you, and they might feel a little shame as well. There's usually a, ha ha, you fell in the dunk tank, especially when an adult does it with the clothes on. Social dunking is that same concept, but you're rolling around proverbially dunking people. They're not actually getting wet, but you're able to dunk on them by saying, hey, I have a better house, car, life, whatever. I went to Buc-ee's 5 times this summer. However you dunk, you dunk. So he's saying, don't do that. Investing is not for that. And then a focus on long-term endurance over short-term comparison. A lot of people want to be long-term investors, but struggle to actually do it. So they get in comparisons with their peers. Girls, what do you think a long-term versus short-term view would be? Can you give an example of that?
Well, long term is like when you actually do it. You actually kind of get focused on it. It's actually long term, where like a short term is just kind of like this is not our real, it's not what we're actually going to do. We're just kind of doing a shorter version of it.
When Noah was building the ark, did he have a long term or short term?
Long term.
Noah built the ark. He had to over years and years and years. Did he not? Difficult. So long term is the way to go, but it's really hard to do. So we've got to stay on the podcast. Got to keep listening. Got to keep those costs low. That investing.
Simple.
That time horizon.
Long.
And if someone ever came up to you and said, "Have I got an idea for you girls? It's a short-term investment," what would you say?
No.
No, short-term doesn't work, guys. It's like it's like that nature thing, trying to grow an oak tree in 2 years instead of 100 years. Come on. And then two data points. This is the Twitter sphere here. Check this out. So SoftBank is their whole purpose, Japanese company, their whole purpose was to invest in artificial intelligence and technology. And then I have an in-show host, Lucy. I want you to, Lucy, grab the coins, put them in one hand, and after I say something, I want you to drop them all in this. So SoftBank thought they wanted to make money. Yeah, you heard them. We have these noises in studio. So what they did is they actually sold every NVIDIA share it had in 2019 for $3.6 billion. Can you guess what the value of that holding would be today, SoftBank? It would be $153 billion. The fund's primary goal was to invest in AI. And they missed on the most important AI company ever. Largest company now in America. Market cap exceeds that of entire European countries. The lesson here is not that SoftBank is unintelligent or that they should have known. It's that individual stock picking is hard. It is really, 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 really hard. If SoftBank, with their armies of analysts, can't quite figure out where to go with AI, and oh, by the way, that's their sole mandate, be very wary of yourself. Be suspicious of your own mind, because we can play tricks on ourselves as investors. We play these little mind games. Oh, what if I had invested in NVIDIA? Ooh, maybe I would have known it. All of a sudden we extrapolate that to, ooh, I need to get the next NVIDIA. Well, we need to go back sometimes and learn that, well, if SoftBank was whiffing like this, I mean, you can't, but let's look at their setup. Are you superior to them? Am I superior to them? Probably not. And then I also just want to, this is just a reminder to me. I'm going to read to you the S&P 500 returns, the annual returns from 2020 to present. 2020, up 18.4%. 2021, up 28.8%. 2022, down 18.2%. 2023, up 26.3%. 2024, so far, it's up 15.8%. Now, that seems red hot, doesn't it? That seems white hot. For the humdum index investor, though, that's just par for the course. That's just par for the. You're going to experience these things when you're able to keep things simple. So we may not experience those returns in the future, but I'm going to tell you what we are going to do in the future. We're going to keep our
costs low and investing simple in a time horizon long.
Until next time.